This is going to help inflation because what it actually does is it throws everybody off kilter. And when this happened, the markets cheered. Of course, that was Thursday. What happened on Friday and yesterday is a different story. That's what the surface shows, the view from far away, that legal uncertainty. The court didn't decide whether importers get refunds. That goes to the lower courts, and that's going to probably be held up in court for years. So it doesn't really change anything. And by the way, if refunds are fully allowed, get it done. Because right now we're seeing the cracks and we're seeing them widen. Slowing GDP, income falling behind inflation, confidence collapsing, legal uncertainty, market chaos, tariff chaos, geopolitical tension. Guess what? I want you to imagine for a minute that there is a massive concrete dam that's holding back rising reservoir. From a distance, everything looks solid. The water seems calm. The structure looks strong. But when you walk up close, that's when you start to see those hairline cracks, tiny little fractures, a little seepage. Nothing catastrophic, at least yet, but enough to let you know that there's pressure that is behind the wall that is building. And I hate to tell you this, guys, but that's where we are right now in the economy. GDP growth is slowing, income gains are falling behind inflation by design. That was right out of the chute. But now affordability suddenly became a word, and it's just getting worse. It's not getting better because inflation, when they say inflation is down, they're just talking about the rate and speed of the inflation. By design, the value of all of that fiat money, that government debt-based money, is going down. This is the first crack in the dam. The economy is losing momentum while prices remain stubbornly high, and they keep going up. And when pressure builds behind a system, the first place that you see it, it's not in the data. It's in the people that are living through it. If you look at this, guess what? 46% of Americans now say that high prices are eroding their finances. That is not a blip. That's 7 straight months above that 40% line. That's not good. That shows a decline in confidence. Sentiment is down a full 13% from last year's 21%. People aren't imagining it. They're living it. So the talking heads can blah, 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 say anything that they want. But frankly, that's why confidence is collapsing. And when income can't keep pace with the prices, well, guess what happens? People lose faith in the system. And that's where we are right at this moment in time. And what happened with the tariffs last week? Well, they were struck down by the U.S. Supreme Court, at least the tariffs that President Trump was using, right? Then we get to the Supreme Court ruling, and that's a problem. The justices didn't address the extent to which importers are entitled to refunds, leaving it to lower court to sort out those issues. And immediately, what do the headlines say? I don't think I have this in there yet. But yeah, Goolsbee this morning came out. He's a member of the FOMC and said, oh yes, this is going to help inflation. Because what it actually does is it throws everybody off kilter. And when this happened, the markets cheered. Of course, that was Thursday. What happened on Friday and yesterday is a different story. That's what the surface shows, the view from far away. Up close, the ruling didn't actually fix anything. It created a new crack.
Recent surveys show nearly half of American households say high prices are damaging their financial stability. That's not a temporary dip in sentiment, it's sustained strain. When wages trail inflation for extended periods, purchasing power declines and savings thin out. Consumer confidence, a key driver of economic momentum, weakens. Historically, declining confidence often precedes downturns, not the other way around. The economy depends on spending, but spending depends on belief in tomorrow. When families feel squeezed month after month, they pull back. The slowdown becomes self-reinforcing. What begins as financial discomfort can evolve into something broader, a systemic loss of trust in economic leadership.
That legal uncertainty. The court didn't decide whether importers get refunds. That goes to the lower courts, and that's going to probably be held up in court for years. So it doesn't really change anything. And by the way, if refunds are fully allowed, well, we're talking about $170 billion that we know of, which is more than half of all tariff revenue collected. I'm sorry, you guys. That is not clarity. That is chaos. And when you're looking in the papers today, what do we have on here? Let's see. American businesses and consumers are unsure of how any new tariffs will affect them, right? And so much of this is about a confused mind, because with all of that chaos, I hope you understand that is a huge tool that governments use when they make the transition from one system into the next system. Because if there's so much that's going on, you don't know what to do. So what does a confused mind do? It does nothing. But this ruling didn't end the tariff era. It detonated a new conflict. And we're going to see what that means, because there's years of litigation ahead and a lot of conflicting lower court rulings, no clarity for importers, no clarity for retailers, no clarity for consumers. This just creates a whole lot of confusion. It's the opposite of the inflation relief that Goolsbee talked about this morning. It's a destabilizer for budgets, for supply chains, for end pricing. And while the public is being told that tariffs are gone, well, frankly, the truth is a whole lot more complicated, because there are a full 7 other tariff tools still available. And here's the part that the public isn't being told. While IEEPA is gone, here are those 7, and they were used. First of all, President Trump called out Section 232, and the most recent one that he called out was Section 122, though there are timelines around that 122 that we've got now an additional 15% tariff that's slapped on everything. So 7 different pathways that the president can still impose tariffs, each with its own trigger, its own bureaucracy, its own litigation risk. So the idea that this ruling reduces inflation, it's a fantasy. It simply shifts the pressure from one part of the dam to another, from one part of the system to the other. And the proof of that comes immediately in this very next headline that there is, right?
Economic pressure intensified following recent legal disputes over tariffs imposed during the presidency of Donald Trump. The Supreme Court of the United States declined to fully resolve refund questions tied to those trade measures, leaving lower courts to sort through billions of dollars in potential claims. While markets initially rallied, uncertainty quickly returned. Trade policy remains fluid, with alternative statutory tools still available to reimpose duties. For businesses, this ambiguity complicates pricing, investment, and supply chain decisions. Rather than reducing inflationary risks, policy volatility adds another layer of unpredictability to an already fragile economic environment.
What does it say? Trump announced new 10% tariffs, and that was now changed to the 15% tariff. Remember, Section 232 is what he immediately used, but then within hours of the ruling, the administration announced that they were going to shift to a new Section 122 and a higher global 15% tariff above that 10%. So this is the key point. Tariffs don't end. They just change lanes. They just change the approach. the president openly criticized the court and immediately pivots to another legal tool. And he's good at it. This current administration knows how to use the courts to get what they want in different ways. But you want to be above that? Physical gold, physical silver, get out of the system. Because this tells us two things. The tariff pressure isn't going away, sorry guys, and the legal fight is just at the beginning. That costs a lot of money too, taxpayer money. This is not stability. This is improvisation at the highest levels of government. And this improvisation is happening at the same time that global tensions are rising. So, what are we going to do about it? We just have to realize that it's not diplomacy. It is a countdown. And as we're shifting from the digital markets, the paper markets dictating gold and silver prices, to the physical markets. And by the way, what if conflict erupts more than it has in the Middle East? If shipping lanes are disrupted, if energy prices spike even more, they're at the highest level they've been in 5 months. Inflation doesn't fall. Guess what? It accelerates. And this is another major crack in the dam. Geopolitical instability layered on top of economic instability and fragility. And yet, despite all this pressure, the markets are, well, they were celebrating. Now they're being impacted by it.
At the same time, geopolitical instability continues to influence commodity markets. Conflict risks in key regions, including the Middle East, threaten shipping routes and energy supplies. Oil prices have periodically surged to multi-month highs, reminding markets how quickly global events can translate into domestic inflation. Energy is embedded in nearly every sector, from transportation to food production. When fuel costs spike, ripple effects follow. Layered atop slowing growth and policy uncertainty, geopolitical stress compounds the strain. Economic fragility rarely stems from one source. It builds when multiple pressures converge, tightening simultaneously around households and institutions alike.
They cheered on Friday or on Thursday. Markets did great, but what happened after that? And oh, by the way, we have states, which I actually like this a lot. We actually have states that are standing up. Now, are they going to get a refund? Because this was their logic behind it. On behalf of the people of Illinois, I demand a refund of $1,700 for every family in Illinois. There are 5,105,448 households in that state, bringing the total damages to $8.68 billion. Is that going to happen? Of course that's not going to happen. But confidence, I mean, real confidence. Well, that comes from what people feel in their daily lives. And as you know, in any con game, you have to have new money, and that's imploding right now, and you have to have confidence. And confidence is probably the single most important thing, because people feel the pressure. They feel what's happening and the prices just keep going up. They feel the instability, that energy in the air. And this, Jamie Dimon came out this morning and he said this feels an awful lot like pre-2008. It sure does. Yep. And Pritzker's demand ignites a new wave of tariff turmoil. And that brings us back to that dam, because this is exactly how structural failures happen. It never fails in one dramatic moment. You see it in one dramatic moment, but it fails slowly over time. And I know people will say, well, Lynette, you've been talking about this forever. Well, yeah, because I've been showing you the evolution. First, you see those hairline cracks, then the seepage, then the fractures widen. And by the time the wall gives way, it's too late to prepare. So that's why I'm telling you to call that number today, talk to a strategy specialist, Don't try and live on hopium. Hopium is not a plan. A sound money strategy that includes community around you to create a foundation that cannot be inflated away, and to also ensure surety in food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. Because right now we're seeing the cracks and we're seeing them widen. Slowing GDP, income falling behind inflation, confidence collapsing, legal uncertainty, market chaos, tariff chaos, geopolitical tension.
Some financial leaders, including Jamie Dimon of JP Morgan Chase, have warned that today's environment carries unsettling similarities to conditions preceding the 2008 financial crisis. Before that collapse, risks accumulated quietly, over-leveraged institutions, inflated asset values, misplaced confidence. The tipping point appeared sudden, but the vulnerabilities had developed for years. Structural failures often follow this pattern: subtle cracks, widening gaps, then rapid unraveling. Markets today remain deeply interconnected and digitally driven, meaning shifts in sentiment or liquidity can move at extraordinary speed, amplifying volatility in ways unseen in previous generations.
You tell me. The pressure is building, and pretending the structure is sound, it doesn't make it so. But here's the part that most people miss. Because when the dam breaks, the water sweeps away everything that isn't anchored. All those paper promises, those digital entries, that intangible garbage, that debt-based money, all of it will collapse as we shift into a new system. Because when one currency dies, another one will be born, and we see it. It's the digital currency. This is the digital revolution. And what happened? Oh, I thought this was quite interesting. We want to talk about this. Give me 2 seconds here. Citrini analysis triggers massive sell-off across global software. So did you see what happened in the markets yesterday? It's all intangible. Things can shift like this, and you are not able to get out. This is why it's critically important that you have the sound money, gold, to properly diversify your portfolio, because all those intangibles, they don't do well in this kind of stress. And the only thing that survives a structural failure are the things with weight, substance, and intrinsic value. 33 different global markets use this. 36 different global markets use that. This has weight and substance. This stuff, one place. This stuff, one place. And that's why for thousands of years, in every single crisis, in every single collapse, in every single reset, people turn to the same foundation, and governments do too. There will be a component of gold when they have finally and ultimately gotten rid of all of the debt that created all of this money. Always, 100% of the time. I'm saying, let's make that redeemable. Let's say you, the public, me, the public, I don't like what I see the government doing. Give me my gold. Doesn't have to be 100% backed. 40% works. Give me my gold. That requires fiscal responsibility and puts guardrails and gives the public back their power. Not because they're shiny, not because they're traditional, but because they are the financial equivalent of bedrock. They don't depend on any court ruling. They don't depend on a government saying, oh, this is money. They'd rather not. They like this much better. It doesn't depend on a political cycle, and they don't depend on confidence because it's a full demand asset. Gold is the anchor. Silver gives you a warning that this was coming. We knew this was coming, didn't we? But gold is the anchor when confidence disappears. This is the moment to act, not out of fear. I don't want you to be afraid because then you can't think clearly. Out of clarity. When systems become unstable, you don't wait for the dam to break. You reinforce your position, you prepare, you build resilience, you secure what you can control. And the most proven way to do that is by holding sound money, something that is completely outside of the system, something that has proven to survive every single monetary failure in history. And there's been lots of them, lots and lots. Because once the pressure becomes visible to everyone, it's too late to prepare. Do you remember what happened in 2008? Were you prepared for that? Because I know that there are a lot of people that are still suffering from it. And movements that have been born from that. The cracks are telling us the truth. And my mom used to say, people will tell you who they are, believe them. Believe these cracks, they are telling you the truth. So are you going to listen? Are you going to make sure that you have a solid foundation to anchor in? Something that's real?
Periods of uncertainty frequently renew debate about the durability of fiat currencies and digital assets. Central banks are exploring digital currency frameworks, while investors reassess traditional safe havens. Throughout history, during currency resets and sovereign debt crises, gold and silver have re-emerged as anchors of perceived stability. Unlike paper assets or electronic balances, precious metals carry intrinsic value independent of political decisions or court rulings. Advocates argue that diversification into tangible assets can provide resilience during systemic transitions. Whether or not dramatic collapse unfolds, history suggests preparation is most effective before instability becomes obvious to everyone.